Welcome back to the Deep Dive. Great to have you with us. Today, we're really digging into a critical question, I think, for global investors looking at Asia. Is the region truly ready for this huge shift in climate capital? Or, are there hidden risks, maybe overlooked opportunities that this new report brings to light? We're diving deep into the latest report from the Asia Investor Group on climate change, the AIGCC. And this isn't just any old document. It's a really rigorous, comprehensive snapshot of how major institutional investors across Asia are actually navigating climate change. So the risks, the opportunities, the capital flows, it's all in there. And the scope is pretty impressive. It's based on a review of 230 significant investors. We're talking a median of what? US $100 billion in assets under management.
Yeah, exactly. 100 billion AUM median. So these are major players.
Right. Both asset owners and asset managers across 19 different Asian markets. So it gives a really broad picture. And for you listening in, we're really zeroing in today on the CEO's Foreword, Rebecca Mikula-Wright's message specifically, and what that means if you're a global investor looking at Asia, or maybe you're already invested there.
And it really matters because, as the report says, this represents mainstream capital ownership and management within the Asia region. So understanding this, it's not just interesting, it's absolutely crucial for any global investor, especially because the climate crisis is, well, it's intensifying everywhere, but particularly across Asia. This information isn't just, background reading, it's financially material. It directly hits the bottom line for beneficiaries in the long run.
Okay, right. Financially material. Let's unpack this then.
Okay.
So let's start with that core message from Rebecca Mikula-Wright, the AIGCC CEO. She says pretty directly that while progress is happening, the pace of decarbonization remains insufficient. Insufficient to limit global warming for, and this phrase caught my eye, Asia's greatest net economic benefit. We hear insufficient a lot globally, right? Is Asia sort of uniquely slow here, or is this just that universal challenge but magnified because of the region's growth? And what does net economic benefit actually mean for an investor?
That's a really good question because it gets to the heart of this dual challenge investors face in Asia. On one side, yes, the global energy landscape is changing fast, renewables are booming, but Rebecca points out continued significant fossil fuel investments across Asia and also the policy environment outside Asia poses significant risk to climate stability long term. So no, not uniquely slow perhaps, but the sheer scale of ongoing fossil fuel investment in such a rapidly developing region just makes the challenge bigger, you see. For global investors, this creates a sort of strategic divide. You really have to pick the winners, identify and back the transitioners in Asia who are genuinely committed, even while these fossil fuel incumbents are still around. That's where the alpha might be in the next decade. And what's absolutely critical, getting back to the CEO's message, is her explicit statement that investors' fiduciary duty includes integrating financially material physical risks, transition risks, and opportunities in climate solutions. It's framed right there, not as just, an ethical thing, but as a core financial imperative. It's about protecting beneficiaries' returns. And despite all the noise, the politicization of climate risk we see everywhere, she really stresses that investors across the region will continue to play a critical role in financing the transition to a net zero economy.
Right. So it's not just a suggestion. It's core to their mandate, almost like a legal duty for those long-term returns. That framing feels significant. So if investors are going to play this critical role, what kind of concrete actions are they actually looking to accelerate? What's the roadmap here for global investors wanting to be part of this?
Well, the CEO's call to action is pretty clear, actually. It involves speeding up portfolio decarbonization, that's one, and directing significant capital allocation, really scaling up investment in mitigation and adaptation solutions, especially in the emerging and developing Asian markets. It also means actively engaging with companies, pushing them towards credible just transitions, and importantly, advocating for stronger government policies too. So for a global investor, this lays out a strategy that goes beyond just tweaking your own portfolio. It's about having real-world influence on economies and policy direction.
Okay. But it's not just what investors should do, is it? The environment they operate in is changing too. You mentioned policy. And for global investors looking at Asia, one of the really compelling things in this report, I thought, was how fast the regulatory side is moving. What are the key things happening there? How should that shape strategy?
You're absolutely right. These regulatory shifts, they create both requirements, mandates, but also real opportunities. They signal clear policy direction, which global investors absolutely need to factor in. So, for example, China's carbon emission trading scheme, it's the world's largest, right?
Yeah.
That's actively driving decarbonization there. Then you have Japan's GX, their green transformation strategy, that's spurring investment. And they've got an emissions trading scheme coming up too, which should speed things up even more. Singapore is really active, developing its green finance sector. They've got the Green Finance Action Plan, their new taxonomy for sustainable finance.
Right. The taxonomy piece seems crucial everywhere now.
Exactly. And Hong Kong is also pushing hard to be a green and sustainable finance hub. South Korea's climate policy is picking up steam. Notably, there was a constitutional court ruling this year reinforcing the government's responsibility on climate. And even within ASEAN, you see movement. Indonesia launched its carbon exchange last year, 2023. Malaysia's got its national energy transition roadmap, focusing on renewables and carbon capture. And just sort of regionally, you see updates on national disclosure standards aligning with the ISSB, that's the global baseline standard setter, more taxonomies popping up, and an increasing focus, thankfully, on adaptation and resilience too. So if you connect the dots, these aren't just random events. It shows a supportive, evolving regulatory landscape that global investors can, well, strategically leverage.
Okay, that is a lot of movement on the policy front. So what does it actually mean for investor progress? On the ground, the report's executive summary breaks this down into key progress areas across 5 main dimensions. Can you walk us through those? What's the headline progress? Where are the gaps still? And crucially, what's the insight for a global investor?
Absolutely. Let's take them one by one. First up, governance. Okay, so the good news is widespread acknowledgement. 75% of Asian investors publicly say climate change is a material risk or opportunity. And that covers, get this, US $95 trillion in AUM. Huge. And 68% have integrated climate into investment policies. That's up 11 points. 64% have board-level oversight. So recognition is there.
Okay, seems positive, but what's the catch?
Well, here's the kicker, the big gap. Only 12% link remuneration paid to climate performance. 12%.
Wow, okay, that low.
Yeah. And while 35% have published a climate transition plan, which is up 7 points, so progress asset owners at only 20% are really lagging behind asset managers at 50%. So the headline for global investors isn't just the 75% acknowledgement, it's that only 12% are putting their money where their mouth is, so to speak, with pay. That shows where real commitment and maybe the opportunity for leadership is still pretty early days.
Right, that makes sense. What about actual investment actions?
Okay, investment. There's definite momentum here. 43% of investors now have net zero portfolio targets. And this is impressive. 34% are targeting or tracking investments in climate solutions or transition finance. That's up a massive 22 percentage points.
22 points, that's a huge jump.
It really is. And 43% have adopted fossil fuel policies. Even things like deforestation policies, biodiversity strategies, they're growing too. However, short-term decarbonization targets. Still relatively uncommon, only 36%. And maybe more concerning, truly effective fossil fuel phase-down policies. They're still the exception, not the rule. And again, asset owners are lagging asset managers across almost all these fundamental investment areas. So for global investors, yes, there's a clear race to put capital into green assets, but that deeper portfolio transformation, the effective phase-down strategies, still evolving. So opportunities in climate solutions, definitely, but also challenges managing those high-emitting assets remain.
Okay. And corporate engagement, how active are investors there?
Right. Corporate engagement. So 39% publish annual stewardship reports. 30% publish climate case studies. 34% integrate climate into proxy voting. 36% are part of climate engagement initiatives. So a sizable minority are active. But the report notes there's still significant room to increase fit-for-purpose actions. Things like publishing detailed case studies or setting formal engagement targets, only 10% do that, are still really underutilized. So engagement is powerful, yes, but global investors should probably be looking for or even pushing for more depth, more transparency, and reporting on specific outcomes to really make it count.
Makes sense. Fourth area, policy advocacy.
Yeah, policy advocacy. About a quarter, 25%, reference climate policy advocacy now, and 23% backed collective statements to governments, which is up 6 points. But transparency here is, well, pretty low. Only 7% actually disclose what kind of engagement they're doing. Collective statements are increasing, but from a very low base. What this highlights, though, is that investors increasingly see advocacy as part of their responsibility to beneficiaries. So for global investors, it underlines how important it is to understand and maybe align with national government priorities. Like mandatory corporate climate reporting, 56% support that, or those 1.5-degree C-aligned sector pathways, which 52% back.
Okay, and the final area, investor disclosure. How transparent are they being?
Right, investor disclosure. We are seeing more transparency. 37% disclose financed emissions, 28% publish advanced scenario analysis, 54% publish disclosures aligned with TCFD or ISSB, the big frameworks. That's up 6 points.
Yep.
And 43% disclose physical risk assessments,
up a healthy 12 points. However, the quality, the consistency of these disclosures, it varies widely. And while assessing physical risk is growing, the report says actual responses to build resilience and adaptation across portfolios remain nascent. Basically, they're identifying the risk, but maybe not acting on it enough yet. And how they use scenario analysis is also quite varied. So yes, transparency is increasing, often pushed by regulation, but global investors still need to look closely at the depth and, critically, the actionability of these climate disclosures, especially around adaptation and resilience.
It's easy to get lost in the percentages, but seeing those gaps is important. What's really interesting, though, is the report includes a concrete example of how some investors are trying to bridge these gaps. Let's talk about that MSCI Espring Prudential case study. How are they doing it?
Yeah, that's a great example. Espring Investments, they're an Asia-based asset manager, part of Prudential Polac, managing about $271 billion AUM. They really show how a data-driven climate transition strategy can work. They used aspects of MSCI's sustainability and climate solutions, which helped them get crucial clarity for their strategy.
Okay, so what are their actual objectives?
They've set clear, firm-level goals. A 55% reduction in weighted average carbon intensity across Prudential's portfolio by 2030, engaging with companies that make up 65% of their portfolio emissions, and hitting internal investment targets for a lower carbon future. And to bridge that climate investing gap, especially in Asia and emerging markets, which can be tricky, they developed their own proprietary framework for investing in climate transition. It's actually endorsed by the Climate Bonds Initiative.
Interesting. So what does the framework do?
Well, it basically provides action-driven guidance. It uses market data, sustainability data, to pick out eligible companies for what they call a brown to green transition. It's sector agnostic, which is interesting. And it also incorporates social and adaptive elements, not just emissions. And they use specific MSCI data points to do this, things like low carbon patents, green revenues data, emissions and targets data, of course, and also social indicators. It really raises that important question, doesn't it? How can other global investors use similar data-driven approaches to close their own climate investing gaps, particularly in these complex Asian and emerging markets? How do you really identify those genuine brown to green transition stories?
So if we were to summarize the key takeaway for you, our listener, it seems Asian institutional investors are making significant strides on climate integration, but it's definitely uneven. There's clearly a divide opening up, isn't there, between the leaders and those still, well, catching up. And that creates both challenges, but also huge opportunities. This report really maps out what's possible and what global investors need to know.
Absolutely. To really protect beneficiaries from climate damage, which is the core duty, investors have to keep improving governance, driving decarbonization in the real economy, directing that capital to transition and adaptation, and engaging effectively with policymakers. This report shows what's achievable. It shows what the leading investors are already doing. And that really is the path forward for mainstream capital in the region.
And just as a final thought to leave you with, the report points out that something like USD $1.1 trillion in annual investment is needed just for climate mitigation and adaptation in emerging and developing Asia alone, but the actual investment's falling short by about $800 billion a year. That gap highlights just a colossal opportunity, doesn't it? For global investors willing to step into this accelerating but still quite nascent Asian climate investment space, a chance to be part of the solution and capture significant value along the way. Thank you very much for joining us on this deep dive. We really appreciate you spending your time with us today.